We just finished going through FuelCell Energy's fiscal 2026 second quarter earnings call materials, and now we want to share our takeaways with you. Here's the tension that jumps right out at you. The demand story is red hot, the pipeline is exploding, and yet the revenue actually went backwards this quarter. On top of that, the company is leaning on selling its own stock just to keep the lights on. So is this thing a rocket or is it a trap? Stick with us, because the gap between the hype and the hard numbers, that's the whole story today. So here's the headline number, and I'm telling you it's a monster. The filing shows the pipeline at 4 gigawatts of proposals, up more than 250% quarter on quarter, with 89% of it tied to data centers. Demand weak. Come on, that's a flood. But here's the other end of the pipe, and this is where it gets uncomfortable. The report shows the signed backlog actually fell down 9.5% year on year to $1.410 billion. The pipeline rips higher, the backlog bleeds lower. Pay attention, because those two should not be moving in opposite directions. The company also stated revenue dropped 5% year on year in the hottest quarter this team has ever seen. And the cash to survive? The report flags it plainly. This lifeline is funded by equity dilution, not by operations. Our take is simple. The interest is everywhere, but a signed data center contract is nowhere, and that right there is the entire battle. Let me paint the old way first, because it is genuinely painful. The filing describes the status quo as multi-year interconnection queues and heavy transmission congestion, just a tangled mess of wires. AI is going to sit and wait years for that. Not a chance. Now here's the company's pitch, and it's clean. The report shows a fuel cell generator sitting right next to the servers, immediate deployment, no waiting on the utility. And here's the detail most folks skip right past. The company stated the output is native direct current, which perfectly matches what the servers actually draw. That means fewer conversion losses, and a reasonable read is that's real money saved over the life of the plant. Then there's the kicker the report calls the efficiency bonus. The waste heat gets routed into an absorption chiller, which directly improves the data center's power usage effectiveness. So they aren't just selling electrons, they're selling speed and they're selling cooling. And by industry logic, that combo hits exactly where the hyperscalers hurt most. This is the part I love, because the business model gets dead simple once you see it. It's the razor and the blade, plain and simple. The company lays out stage 1 as the razor, the initial equipment sale, delivered upfront at a 10% to 20% target margin. Not a fat margin, right? That's the razor. You don't make your real money there. Stage 2 is where the meat sits. The filing shows long-term services and power purchase agreements, recurring revenue running 15 to 20 years at a target margin north of 20%. 15 to 20 years of higher margin cash off a single install. That's the blade, and that's the prize. The company even states the lifetime value of that service contract runs significantly higher than the upfront equipment sale itself. So the report frames total order value as upfront cash plus decades of high margin tailwind. Our take, you can't judge one of these orders by the sticker price on the box, because the tail is where the value really lives. So why is this whole thing blowing up right now and not 5 years ago? The filing shows traditional power demand crawling up a gentle line, while high-density AI computing jumps straight up in a step change. And the company's point is blunt. Grid build-out timelines simply cannot cross that gap in time. Somebody has to fill that hole, and fast, right? That's the opening. Now, here's why their box gets through the door so easily. The company lays out a site selection checklist. 1. The report states it is exempt from Title V air permitting, so you skip the ugly permit fight. 2. The company stated operational noise lands at about a residential air conditioner, so the neighbors don't revolt. 3. It stated ultra-high land use efficiency, which matters a ton when the site is tight. Our take. The pitch has flipped. This stopped being a green energy story and turned into a how fast can we get permits and flip the switch story. Here's the actual weapon, the 12.5 megawatt energy block. The company shows it built from a 125 megawatt module, stacked out into a bigger block, not some fragile new prototype. And here's the smart part. The report states a shared balance of plant lets clients scale out without overbuilding. Translation, you add power in chunks as you need it. You don't sink cash into capacity that just sits there idle. Now for the part that actually closes deals with the big boys, the track record. The company stated 23 years of operating history, and that is not nothing in this game. It stated nearly 50 years of cumulative utility scale runtime across just 5 sites. And get this, one single unit has run continuously, uninterrupted for 13 years straight. A reasonable read is that kind of uptime record is the real proof a hyperscaler wants before it signs anything. Our take, the technology risk here is low. This thing has been grinding away reliably for 2 decades. Now here's the gut punch, the one that just doesn't fit the hype. The company's stated revenue came in at $35.6 million, down from $37.4 million a year ago, a 5% drop. The hottest theme on the whole market, and the top line goes backwards. Yeah, chew on that for a second. The filing walks through why there were no module replacements this quarter, and that hit service revenue. On top of that, the Groton plant was down for maintenance, which dragged on generation revenue. What kept it from being even worse? The report points to Korean GGE module deliveries and a slight uptick in advanced tech. But here's the line that matters most, and the company put it bluntly in its own diagnostic. Revenue right now is sustained entirely by Korean deliveries and legacy plants. Zero recognizable revenue is flowing from that 89% data center pipeline. None, not a single dollar. Our take is harsh but fair. The future is sitting in the funnel, but the meals on the table are all the old ones. Okay, the headline number is ugly, and it is going to scare people right off the stock. The company stated an operating loss of $77.9 million and a net loss of $77.6 million. Before you bail, let me show you what is buried inside that figure. The filing shows a $42.6 million non-cash impairment tied to the Groton project, and the company framed it as a strategic move, upgrading a 7.4 megawatt naval base over the 3 of its current 2.5 megawatt modules. Non-cash, that is the key word. No actual money walked out the door. It is an accounting write-down. Strip that one-time hit out, and the picture changes completely. The company stated core adjusted EBITDA at negative $17.1 million, improved about 12% year-on-year from negative $19.3 million. A reasonable read is the underlying cost discipline is real. It is just buried under one scary headline number. Our take, don't let a single accounting charge fool you into missing that the core spend is actually tightening up. Now here is the number that quietly tricks people, so watch this one. The company stated the net loss to shareholders actually doubled, from $38.8 million to $78.7 million. But the per-share loss got smaller. The report shows it improving from negative 1.79 to negative 1.45. The total loss doubles, yet the per-share number shrinks. How does that even work? Simple, they blew up the denominator. They printed a whole pile of new shares. The filing shows an in-quarter ATM raise of 10.9 million shares at 9.45 average, pulling in $104 million. Then after the quarter closed, the company stated another 4.1 million shares at 13.31 average for 52.9 million net. That left ending cash at a healthy $440.9 million with near-term debt effectively zero. The balance sheet looks great, sure, but a reasonable read is the survival ammo was bought entirely by diluting the people who already own the stock. Our take, that EPS improvement is not profit getting better. It is just the pie getting sliced into a lot more pieces. Let's go back up to the top of that funnel, because the size of these deals is jaw-dropping. The company stated the average deal size jumped to 130 megawatts, double the prior baseline of 65 megawatts in a single quarter. Deals doubling in size like that tells you exactly who is walking in the door now. A reasonable read is these are hyperscaler class buyers, not the little guys anymore. The filing puts total pipeline at 4 gigawatts, up more than 250% quarter on quarter, with 89% of it data center. And the company stated the breadth spans distributed generation, utilities, and hyperscalers all over the globe. Sounds incredible, and it is, but here comes the cold water. The report is dead clear this is inquiries, diligence, and proposals. It is not finalized signed contracts. And here is the catch. The bigger the deal gets, the longer the due diligence drags on. I'll take the interest is the real deal, but a 130 megawatt order does not close on a quick handshake, and that is the rub. Here is a piece of good news. The company is scaling up its ambition. The company stated it is lifting the capacity target from 350 megawatts up to 500 megawatts a year. The filing pegs the cost of that full build out at $200 to $275 million. But don't read that as them swinging wildly, because the tone here is careful. Management's mandate, in its own words, is to strictly align with signed backlog and structural funding, zero speculative overbuilding. A reasonable read is that smart discipline. You don't build a factory ahead of the orders and then bleed cash babysitting it. Then there is a quieter piece most folks skip right past, the carbon capture angle. The company stated 2 advanced units are en route to Exxon Mobil's Rotterdam site for June delivery, backing a $15.4 million advanced tech backlog. And management flat out says the market is completely mispricing that tech optionality. Our take, if that line ever turns real, it is a whole second engine the market is not paying a dime for today. Here is the contradiction that should stop you cold. 2 lines moving the opposite way. The pipeline line rockets up. The filing shows 4 gigawatts with 89% of it data center. But the backlog line bleeds down. The company stated signed backlog fell 9.5% year on year to $1.13 billion. The funnel explodes while the signed book shrinks. Pay attention because that is not supposed to happen. Now let's do the autopsy on that 114 billion because the makeup tells the whole story. The filing shows 928.5 million is legacy generation under long-term power agreements. That is old business. Services sit at 155.4 million and the actual product backlog is just 36.1 million, mostly Korean repowering. So where is the data center hiding? The company's own bottom line says there is zero recognizable data center product in the signed backlog. Our take: the headline demand is dazzling, but this company is still kept alive entirely by old legacy contracts. The new story has not dropped a single dollar into the signed book yet, and that is the cold truth. Let's be fair here, the moat is real, no pretending otherwise. The company points to native DC output, real PU benefits, and a 23-year history that all validate the technology. But proven tech and a profitable company, those are two very different things. The company stated the current run rate is sustained entirely by long-tail legacy service and generation backlog. And here is the gap nobody wants to talk about, the cash burn gap. The company was blunt. Expanding the factory to 500 megawatts does not change the baseline survival math. The real line in the sand is 100 megawatts of annualized production, management's own hard threshold just to target positive adjusted EBITDA. Do the math yourself, they are nowhere near that number today. A reasonable read is that until production securely clears 100 megawatts a year, profitability stays a target, not a reality. Our take: the moat can be as deep as it wants, but turning those proposals into signed orders is still the single biggest question mark hanging over this thing. Alright, let me put the warning lights up on the dashboard because there are 5 of them blinking. Flag 1, timeline evasion. The company stayed highly reserved on specific contract conversion dates, and these mega deals carry no fixed timelines. Flag 2, dilution. The company did not rule out more equity raises to fund that 200 million plus expansion, so more share printing is on the table. Flag 3, lumpy revenue. The second half of fiscal 26 leans entirely on choppy Korean GGE and CGM deliveries with zero concrete guidance. Flag 4, backlog attrition. The company noted that without new signings soon, the legacy backlog just systematically bleeds down. Flag 5, distance to profit. The math gap to that 100 megawatt break-even is still, in the company's words, vast. Our take: none of these is a deal breaker on its own. But while these 5 lights stay red, this story has not truly turned the corner yet. Now step back and look at the deeper problem, because this is the one that really matters. The company describes AI software demand moving at the speed of code, needing immediate power scale up, and that is the 4 gigawatt pipeline. But physical infrastructure moves at the speed of concrete, permitting, and 100 megawatt plus enterprise due diligence. See the mismatch? One side sprints, the other side crawls. The company said it straight: the bottleneck is not customer interest, it is decision speed. And here is the twist: that jump to 130 megawatt average deals actually makes it slower because bigger deals drag the due diligence out longer. The company's own posture, this proof over promise mandate, is really an honest admission that mega deals take time. A reasonable read is they basically just told you the orders are not locked yet. Our take: this is now the ultimate show me story. The demand is obvious, but the gap between 4 gigawatts of interest and a shrinking 1.41 billion backlog is the whole ball game. Okay, here is your watch list, the scorecard for the next 4 quarters. Number 1, and this is the big one, did they land that first data center firm order they targeted for fiscal 26? Number 2, backlog direction, did the bleed stop? And did any real data center product finally show up in the signed book? Number 3, annualized capacity, is production actually marching toward that 100 megawatt survival line? Number 4, adjusted EBITDA, did the loss keep shrinking past negative 17.1 million? Number 5, dilution, how hard is management leaning on that ATM to print new shares? Number 6, did the lumpy Korean GGE and CGM deliveries execute cleanly in the second half? And number 7 to 9, watch the tape caster install and the incremental MW unlocks, the June Rotterdam carbon capture delivery, and whether those 130 megawatt deals actually close or just sit in the pipeline. I'll take, nail these 9, and you will not get whipped around by the headline noise. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.